Hi everyone, very good afternoon and welcome back to Grade B. So today we are going to talk about the IRDA topic on financial markets, right? We'll be discussing this in question answer format. Just wait for a second. Yes. So first of the questions that we have is talking about comment on the interconnectedness of India's financial sector, explain its implications on the Indian economy. So this question wants to know about that what is the interconnectedness among the different sectors. See, we all know that the banks, they give lending to NBFCs, right? NBFCs give it further on, and hence there is a total circle involved in it, right? We all are aware about it. So the question wants you to address all these aspects one by one. Let us see this. So first of all, let us define the financial system. Financial system, it can be visualized as a network with financial institutions as nodes, bilateral exposures as links which are joining these particular nodes. Basically, we are talking about that these financial systems, they put their investments and deposits into each other, and this thing leads to the interconnectedness, right? Number one thing. While these links, they enable efficiency gains and risk diversification, they can become conduits of risk transmission in case of a crisis, right? So let us talk about the financial system network. What is this? Interconnectedness of the financial system can be seen through the bilateral transactions among these particular financial institutions. I told you that these institutions, they give lending and borrowing to each other, and this is how our financial system works. So these may include NBFCs borrowings from banks, interbank. Yes. So here we'll be they are telling that in financial stability report you can find all this data which is relevant for you, right? That means they will be telling you that what are the interconnectedness between the different financial market, different financial institutions. Now, starting with the scheduled commercial bank, one by one we are going to address all the things. Scheduled commercial banks, they continue to have a largest bilateral exposures in the Indian financial system, right? Although their share has declined from 43.9% to 43% in the March 2023. In terms of intersectoral exposures, ACMFs, insurance companies, PSBs, they were the biggest fund providers, whereas NBFCs and the PVBs, they were the largest receivers of funds, followed by the HFCs, housing finance companies, right? So all these things we are going to see one by one. So these were what? They were the fund providers, and your NBFCs as well as your HFCs, they are what? They are the fund receivers. So asset management companies, mutual funds, they were one of the fund providers. So gross receivables of the mutual funds, they stood at 13.29 lakh crores, where their gross payables was only 0.73 lakh crores. So scheduled commercial bank, they continue to be the major recipient of their funding, followed by NBFCs, AIFIs and HFCs, right? So all India financial institutions, scheduled commercial banks, etc., they all borrow from the asset management companies, mutual funds, right? Next we have insurance companies. Say all these, they are the fund givers because they are receiving money from investors. So they are a kind of saving vehicle. ठीक है, यहाँ से funds investor के पास आता है, investor से पैसा इनके पास आता है, and then they give it to further scheduled commercial banks, housing finance companies, etc. Insurance companies. So gross receivables of insurance company, it stood at 8.49 lakh crores and gross payables were just 0.50 lakh crores. These are the data of March 2023. So scheduled commercial banks, they were the largest recipient of their funds, followed by the NBFCs as well as the HFCs. Next is we have non-banking financial companies. So they were the largest net borrowers. They are the borrowers. See, because they do not have investors' role as much, right? They do not receive the direct fundings from the investors in most of the cases. That is why they are dependent on the scheduled commercial banks as well as these AMC mutual funds, etc. on these to get their funding. So you will see over here that NBFCs, they were the largest net borrowers of the funds from the financial system with gross payables of 13.68 lakh crores and the gross receivables of 1.74 lakh crores as at the end of March. So these were their payables and these were their receivables. You can see the vast difference that is existing between the receivable and payable. They have way lesser receivables and way more payables. So that is why you might have seen that in the year 2019-2020 we have witnessed the NBFC crisis as well. ठीक है, इसी वजह से NBFC crisis भी हुआ था because they have huge borrowings and there was an asset liability mismatch while doing their borrowings. Okay. So their largest exposure was in the terms of their borrowings from scheduled commercial bank. They have borrowed from scheduled commercial banks, although it came down in the Q4, whereas their borrowings from the asset management companies increased. Next we have housing finance companies. Through this, see, we are discussing all the interconnectedness that is existing in our financial market. ठीक है, हम सारा discuss कर रहे हैं. You see, in housing finance market, they remained the net borrowers. They remained net borrowers and they had gross payables of 7.93 lakh crores against the gross receivables of 0.44 lakh crore. All those who are borrowers, right? All those who are borrowers, you can see that there is vast difference in their receivables and payables. Their receivables are less than the amount that they have to collect from the market, and the amount that they have to pay to the market is very much high. Fine. Next we have the All India Financial Institutions. All India Financial Institutions, they were the net provider of funds to the financial system with their gross payables and gross receivables being 6.43 lakh crore and 6.52 lakh crore respectively. There is not much difference. That is why we are called them as All India Financial Institution. For example, your SEBI, Exim Bank, they have been made to provide the finances. ठीक है, उनको बनाया ही इसलिए गया है so that they can provide the finances to the financial sector. Now let us see the implications on Indian economy. What are the implications of it? The impact of interconnectedness of India's financial sector can be understood better with the contagion analysis. What is contagion analysis? See, whenever we see the word contagion, contagion का मतलब होता है contagious, which can spread very easily among others as well. ठीक है? So that is what we know as that for sometimes for diseases we call it, right, that it is a contagious disease. So the similar thing is over here as well. Okay. So contagion analysis will be done. Contagion analysis का मतलब क्या होता है? We are using network technology so that we can estimate the systematic importance of different banks. Systematic importance का मतलब क्या? कि if this bank will fail, then there will be impact on the other financial institutions as well. You can see this is the bank and there are various financial institutions which are interconnected with it. So if this bank will fail, then there will be a very negative impact onto the other banks as well, or let's say other financial institutions as well. So the failure of a bank which is systematically important, it leads to the greater solvency and liquidity loss for the banking system. So that is why you might have seen that we always carry out the analysis domestic systematically important banks. We know this. Why? Because so that government can take apt steps whenever needed. जब भी कभी ज़रूरत हो तो government can take the steps because government understands that this bank is very important for our financial system and we cannot let this bank fail. Okay. So losses of scheduled commercial banks due to the bank failure, let us see. So a contagion analysis of the banking network based on the end March 2023 position indicates that if a bank with a maximum capacity to cause contagion loss fails, it will cause a solvency loss of 2.22%, right? of total tier 1 capital of the scheduled commercial banks, and there will be a liquidity loss of 0.25% of total high quality liquid assets of the banking system. Here we are talking if any domestic systematically important bank or financial institution fails, then this is going to be the impact of it. 2.22%, there will be an impact on the capital. In the Basel norms we have seen that what are the capital norms, right? So you have to maintain a capital ratio. So this will be the loss in the tier 1 capital. There are two types of capital, tier 1 capital, tier 2 capital, and this is the loss that you are going to see in the tier 1 capital, right? Next is losses for scheduled commercial banks due to NBFC failure. So NBFC agar fail hote hain, like we have seen the ILFNS crisis, right? IL and FS crisis we have seen. It was having a very, I'll not say very huge, but it was having a significant impact on the banking system as well as the financial system as a whole. So NBFCs and HFCs, they are the largest borrowers of the funds from the financial system. A substantial part of their funding comes from the banks. So they borrow it from the banks. That is their major source of funding. So failure of any NBFC or HFC will act as a solvency shock to their lenders. By end of March 2023, idiosyncratic failure of the NBFC with the maximum capacity to cause solvency loss to the banking system would have knocked 2.51% of the letters tier 1 capital. So this is going to be the impact, I guess. Wait. Yes. 2.51%, it will be the loss to the bank's capital. After that, it would have led to failure of any banks as a funding from banks has come down and the banks are also better capitalized. Similarly, failure of the HFC with the maximum capacity to cause solvency loss would have knocked off 4.42% of the bank's tier 1 capital. So here we are discussing that if an NBFC fails or an housing finance company fails, in that case, what will be the impact on the tier 1 capital of the banks? So this, you should remember this, right? So how we got to know this? By doing the contagion analysis. What is contagion analysis? Contagion analysis is when you do the analysis through the networks, that okay, this bank is having networks in these many NBFCs. So if this bank fails, there will be an impact on other NBFCs as well. अच्छा, ये NBFCs अगर किसी और से लिंक होंगी तो उनके ऊपर भी impact आएगा. Getting my point? Next is the macroeconomic shocks. Any contagion from the failure of a bank is likely to get magnified if the macroeconomic shock results in the distress of banking system, right? No bank fails to maintain tier 1 capital adequacy ratio of 7% in any of the scenario. As a result, there is no additional solvency loss due to the contagion. In conclusion, network analysis tells us that contagion risk and the consequent additional solvency loss have reduced since the last issue of the FSR Financial Stability Report. There would be no additional solvency loss from the contagion due to the macroeconomic shocks. अब देखो यहाँ पे आपको ये बताया जा रहा है that banks they do maintain their capital ratios, adequate capital ratio. If they have maintained the adequate capital ratio, then the loss to their solvency will be at a reduced level. थोड़ा कम होगा, इतना ज़्यादा नहीं होगा, right? As global financial conditions and the geopolitical situations they remain highly uncertain, Indian financial system we need to adopt a nimble and preemptive approach to dissipate the signs of any particular stress that are coming to our way. So what we can do? What are the keywords that we need to remember over here? Let us see. See, first of all, you can have the risks from the geopolitical situations, right? So for that, what you can do? You can install early warning indicators, maintain sound and the public confidence, and meet the financing requirements. So over here, the keyword for me is early warning indicators. Early warning indicators means जैसे Basel norms में बहुत सारे indicators बनाए गए हैं. Liquidity ratio आपका बनाया हुआ है. Apart from that, leverage ratio has been made. The capital ratio has been told to you. So these are all what? These are all that tells you that how you have to keep the financial system healthy, right? Next, we need to read about the short note on the following, that is systematic risk and concentration risk. Let us see this. So what does systematic risk means? Systematic risk or non-diversifiable risk का मतलब होता है the risk inherent in the whole market. Non-diversifiable means, see, suppose I have 1 lakh rupees, I can invest in different kinds of securities and that will save me from the risk, right? If I will invest my total amount in the equity, then that is compulsorily going to cause me a loss. Pakka loss hoga. But if I invest that amount in different securities, it will help me out, right? It will help me out. So it affects not just a particular stock but the overall market. तो आप कहीं पे भी invest करो market में, you are going to face the risk. This kind of risk is not only unpredictable but it is also absolutely impossible to avoid. It cannot be mitigated by the diversification or by hedging. What is diversification and hedging? When I invest my amount in different securities, that is called as the diversification. I am not investing my total amount in one type of security. I am investing it into the different kinds of security. So it gives me the benefits of diversification, right? Now, to manage the systematic risk effectively, investors, they should ensure that their portfolios include a range of asset class, cash, real estate, as well as the fixed income. You see, there are different kinds of asset clauses over here. Now, each of which will react in different way in the event of significant systematic change, right? For example, an increase in the interest rates will make certain new issue bonds more valuable while causing some corporate stocks to fall in prices. So these are the different things and they can have the different impacts in the market. What is important for you is that you keep investing your amount in cash, real estate, fixed income. That means you have to keep diversifying. You cannot stay in one kind of asset price, right? So ensuring that a portfolio contains enough income generating securities in the event of interest rate rise. Whether whatever be the market scenario, you will be earning the income. Now next is we will be talking about the concentration risk. Concentration risk occurs when there is too much investment in single industry. Suppose I have 10 lakh rupees and the total 10 lakh rupees I have invested in REITs, real estate investment trust. So all of my investment is just into one kind of sector. It is going to cause me losses. ठीक है, इससे मुझे losses होंगे. So putting 50% of the portfolio into a single stock, procuring more than half of raw material from a single vendor, lending more than 50% of credit to single borrower. Now you giving to a single borrower 50% of portfolio in a single stock. Suppose you have purchased a stock of TCS. So आपका पूरा 50% जो है वो एक ही तरीके की कंपनी में है. This is going to cause you losses if anything happens to that company, right? But if my investment is well diversified, then my risk is also diversified. I need not worry about the market situations as much as I would have worried that if I would have invested 50% of my total capital into TCS. तब मुझे ज़्यादा चिंता होती, right? So concentration risk, they can be reduced by employing the diversification, be it in our stocks, vendors or borrowers. Diversification helps in reduction of risk by allowing the different entities to balance the risk. One of the most famous example is hedging. Hedging का मतलब होता है taking offsetting position in an asset that reduces the price risk from the existing position. Suppose I have to sell a wheat. So what I can do, I can enter into a contract where I am purchasing wheat. ठीक है, यहाँ से purchase करके यहाँ पे दे देंगे. So this is going to hedge my risk, right? So इससे मेरे risk का नुकसान होने से बच जाएगा. A hedge is a trade which is made with the purpose of reducing the risk of adverse price movements in another asset. Normally a hedge consists of taking the opposite position in related security. So अगर आपने देखो what happens is I gave you example of wheat. on one hand I am selling the wheat and on the other hand I am purchasing it. So यहाँ से purchase करके I am going to give it over here. This is going to reduce my risk considerably, right? इससे मेरा risk बहुत कम हो जाएगा. Why? Because I will not have to invest from my own pocket. So these are the things that are related with the hedging. These were the concentrations, your risk related topics that we need to discuss in the question answer format. Thank you so much for joining in. This is it from my side.